Welcome to Volume 7 in the continuing series of the Market Maker Collection. We're going to be focusing on the ICT cell model here, and it's going to be pretty much a mirror image of everything that was described in the previous installment, Volume 6, where we discussed the ICT buy model. And you're going to see that while many of you have really made it much harder for a concept to be absorbed than it needed to be, there is an overlapping between both the sell and buy model. And it's because the pattern is a fractal. And fractals move inside one another, they inhabit one another, they reside in one another. And where one market profile ends, another one begins. And even where that transition takes place in a larger scope of that section of price action, you actually see, in other words, inside of a buy model, there may be a sell and a buy model in smaller time frames. Okay, but overall, between those three overall fractal patterns, they make up the larger one. So it's important that you understand that we're really basing this entire premise on the inherent nature for price action to be fractal in in a generic term. But many times it's been tossed about by mentors and even myself. I'm guilty of this as well. That we rather mention it glibly that fractals are easy to see. Well, without really breaking down a market or a sample set of price action, it's really hard for one to come away with an understanding of what is deemed a fractal. Um, every single time I've come in contact with a mentor or an author or someone that refers to fractals in price action, I'm I'm quick to ask them, what is a fractal to you? I ask this of you know of people that will ask me in an email, is this a fractal that you would go long in? Well, I ask them all the time, what is a fractal to you? Because just because there is a label applied to it by someone else doesn't necessarily mean that that is the same thing that we all see. Okay, um, and I'll give you an example of that. If we look at a head and shoulders pattern, classic price action. Okay, a head and shoulders pattern in early stages of trading may not be so clear to one another. Okay, we could all look at a chart. If we all simply went back to the very beginning day of us looking at a price chart and we looked at a head and shoulders price pattern, if every one of us had the same example placed in front of us, it goes without saying not all of us would have identified that as a head and shoulders, even if we were conceptually shared the general idea what a head and shoulders pattern is. And it's simply because we haven't warmed up to the the discovery of what it looks like and understanding what it looks like and how does it become evident in price action. Because without the understanding of how that takes place, talking about these things conceptually, and whether it be you know broad brushed and vague as we have here in a very conceptualized manner in this ideal depiction as I see a fractal, um, it won't make any sense to us if we don't have a framework to build upon. And that's what we're doing here in volume 6 and volume 7, to give you an idea on how I see price action, how I view price action. Because no matter what you uh, look at the market in, whether it be 5 minute, 1 minute, hourly, weekly, monthly, doesn't matter the the time frame at which you're looking at price. It's the manner at which you're looking at price. Okay, because if we can uniquely remove all of the distractions and just get to the core of what is price action doing right now based on what it has done most recently, and if we can have a higher time frame premise in addition to that, it moves along the odds of our being successful in an exponential fashion. So without all that preamble, let's get right into this one. We look at the buy model, okay, and I'm assuming you probably just watched that video. So if you're looking at this, you'll see this is pretty much the mirror image of what we disclosed in the buy model. The initial consolidation, okay, um, this is where orders are accumulated, And I know most of you will probably assume that this should say distribution to accumulation, and that's not the case. Okay, the markets are always predisposed to be um, sellers. Okay, so they're going to sell, 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 and by selling, they are accumulating. And I know that's hard for some of you to grasp, but you got to look at it from an institutional side. You're accumulating orders by being the storehouse or the seller. Okay, none of us can buy British pounds without there, yes, being a supply house or okay or a central bank that um, prints that particular currency. They have to accumulate always. Now, by their accumulation, the way they will offset their risk, okay, or reduce their risk, manage their risk, or profit, they will distribute. Okay, so it's important to understand that the central banks are in business to, yes, provide liquidity, but they're also a business. They're not just simply there to give everyone free opportunities to make money. Okay, so the initial consolidation here is an accumulation phase. The market will move into the run to resistance. Okay, and then the next stage is the smart money reversal. Okay, so any longs that they would have accumulated in here or hedged on a larger time frame position, maybe this is um, a short bear market, and they would have accumulated some long positions to hedge during a anticipated move higher that would set up a longer term additional selling point where they could get more short positions in the marketplace for their longer term trade lower. So they could accumulate longs in here to do what? To hedge their short position, okay? And they'll reaccumulate in here and buy more, and it'll run to a level of resistance, and then they will distribute what they had hedged back here, okay? And by going short in here, as the market starts to break down, the next level is the distribution for the low risk sell. This is where it's clearly seen many times by a lot of guys in my camp where they'll see the optimal trade entry. Okay, market structure will break up here, then they can classically see the ICT optimal trade entry, 62 to 79% retracement level, or what we dub classically the 70.5 fib retracement level into a previous order block, and then they would get short. The next stage is either a redistribution, okay, or in other words, an increase of more selling orders or short orders, or like we had in the previous teaching about the ICT buy model, this stage here can be a reaccumulation point. Okay, in other words, this could be a buy, a retracement here just to reaccumulate more longs that they had accumulate here or in here. Okay, so in this area here, we could see the resumption of a longer term uh, bull trend, okay, or this could be redistribution. And this is where you're going to get hung up if you do not have a higher time frame premise. Yes, you can trade without a premise. Yes, you can trade without a bias. But the problem is you're going to get hung up here all the time. This is going to be the trap for those individuals that simply don't want to trade with a bias. Okay, they're going to get banged around in the marketplace right here because they're going to be looking for additional selling short positions, and it won't happen. What will happen is they'll continue to move higher and trade, you know, eventually taking out this high here. But then we're going to stick with the classic definition of a sell model here. The next stage from this redistribution or new area to go short, they would eventually move down into the distribution level. Or say they accumulated here and they're distributing here. They're distributing here as well. What are they distributing here? What they went long here. What are they distributing here? The long-term positions that they accumulated on a higher time frame short position that we can't see in this graphic depiction. Say this is a downtrend. This would be a classic selling in a down market, selling it up here. Well, if they sold it here, they can distribute those shorts or cover them basically here. Or if it's in again like a higher time frame bear trend, we could assume that they had been long much farther back in time, and they would be covering here after they neutralize the orders that would be resting below here. Okay, so we have a couple different ways to use this price pattern, just like we discussed in the buy model. You can view the market in several stages and different durations, whether it be, for instance, let's just look at this in form of, say this is an hourly chart. Okay, we could look at being a buyer in here, okay, with the anticipation that we're going to see a move here, moving up into a level of resistance of some sort. Okay, and that right there could be what you would use just to nail down a 30 pip trade. And I've taught many times that you can build a career on 30 pips per week if it's done consistently, and you optimize your equity and how you're allocating that money, and managing the risk. If you're consistently doing that exponentially, your money can grow to, millions theoretically, just by taking 30 pips every single week. Problem is you're not going to stop at 30 pips, but nonetheless, if you take these types of surgical precision entry points from here to here, you'll know that yes, you could be in a mood that continuously moves higher. But as you begin to understand how we work within fractals and price action, you'll learn by every single trade you take. Hopefully, if you keep in detailed notes about why you went into the trade, take screenshots of what it looked like before you went into the trade and what it looked like afterwards, okay, and spend a lot of time studying that. The losers you should spend time with, yes, but don't beat yourself up about it. Because if you do that, what you're going to do is you're going to build a toxic view of your personal approach to trading, and you'll keep reaffirming to yourself that you're a loser. Your ability to make money is absent, okay, and you're void of understanding, and therefore you're wasting your time. Okay, the way we use the losses in the marketplace is to frame it on what we understand, basically in the context of what we're sharing here. How did it meet this model? What did we do in the trade that didn't line up with our understanding of how price moves in fractals? And by doing that, what will happen is by default, over and over and over again, you'll see your results glean more understanding. And that's why it's important that you keep your risk very, very, very small, less than 1%, less than a half a percent when you're first starting, because it's not about making money. It's about consistently finding an approach that fits your psyche and using these concepts. Because if you blend the two together, not all of us are going to use these concepts exactly the same way. They're not. And when you see later on in this video the examples of the fractal patterns that are available, you're going to see how all of us will be able to see the same price chart, same sample size, and see different trades within that same context of price action. That little block of area of price action that we're going to look at later on is going to be a plethora of opportunities using both a buy and sell model, and neither one being wrong. That's the paradox of fractals, because you'll see a bullish buy model, and I could see a sell model, and either of us, okay, are liable to make a profit. But yet, if we were to contrast one another's analysis in the beginning, we could scare one another out of the trade if we listened to the other person. You follow what I'm saying? So that's why it's important not to bounce ideas off of what you're intending to do with your trade. You don't care what anyone else is doing. Okay, you have to have an individualized mindset about trading, and by giving yourself a framework like this, okay, and this may not work for you. I'll be honest. I'm cognizant of that. This may not make any sense to you, but I think if you give it a fair shot and spend a little bit of time with it, it will give you a solid foundation to, if not stick to for the duration of your career as a trader, or at least lead you in a direction where a greater understanding will be needed in studying certain things. And like I said, it'll help you along by some measurable uh, amount. I can't obviously say it's going to be equal to everyone, okay, but for those that have used or tried to use the model, these two videos I believe will absolutely open up and unlock the understanding that you should have using them. So with that, let's go into a little bit more detail. Now again, we have the initial consolidation over here. Okay, and how do we identify when a sell model is forming? Well, nonetheless, it's important that you have to go back and understand that these these sell patterns are really easy to see in bear trends. Okay, when you're in a downtrend, the market maker sell model is going to be very, very clear. It's easy to see. Okay, but I'm going to show you in this video how you can see the sell models in bullish conditions. And that's going to be like, what? What are you talking about? And you'll see it. And once I show it to you, you'll say, well, yeah, there it is. And by seeing it and studying this video, don't just watch this video once, okay? Because this video is actually going to be better than we showed in terms of the concepts. The things that we discussed in volume 6 will help you blend the two together. And trust me, you'll never look at price action the same after these two videos. I'm not saying these are two most important videos of the series, but these two particular videos will unlock your vision of price action. Okay, and you'll never look at the markets the same way. Okay, and it's absolutely be empowered by having this understanding. But assuming for a moment that we're not trading with a bias, okay, we can identify a support level, or what we understand from previous teachings of mine, an order block, okay, which is necessary. So when we come into an area where we anticipate a level of support, okay, and support can be horizontal uh, support and resistance based on an old high, an old low, okay, or it could be a bullish order block, okay, and the higher time frame is ideal, okay, and that means the monthly, weekly, daily, and 4 hour, and no less than a 1 hour. Okay, because if we trade with fractal patterns like this, less than a 1 hour, many times the opportunity to make pips are reduced so low. And I'm going to speak from my own premise of looking for trades. I don't like taking 10 pip opportunity trades. Can you build a career on it? Absolutely. To me, I just don't think it's worth it. Now, some may argue that, that's their cup of tea. And now I'm not going to try to discourage you from doing that, okay? But I'm just saying that I like to see these patterns form on an hourly basis to give me the framework of what I'm looking for. Nothing less than an hour. Unless I'm really, really ultra intraday trading and scalping, then I'll look for it on like a 15-minute chart. But you can use it still nonetheless in the overall context of price action to map out where the order should go from point A to point B to point C, okay, as we're going to discuss here. So at a support level or an ICT bullish order block, if we see consolidation and a rejection of that area moving up into an area of anticipated resistance, okay, and again, that resistance come in the form of horizontal support resistance, an old low, an old high, and or a bearish ICT order block. Okay, and if you don't know what an ICT order block is, you don't have any business watching this video series. You need to go back to the Sniper series and Precision Trading Concepts. Once we come into an area of resistance and or bearish order block, okay, we would anticipate a breakdown of the market structure as we have here graphically described, eventually coming back down, neutralizing the original order here. Because when we see a level of support, assuming, okay, for a moment, sticking with the idea that this is a bounce in a bear market, if we come down to a higher level time frame order block or weekly support level or daily support level, we have to anticipate the likelihood, even though the trend may continue going lower at a later time, the likelihood at this higher time frame support level, and especially if it's a solid order block, price has an opportunity to do what? Bounce. Okay, so even though we see the market move up and find old resistance turn support here and continuation move higher, when we enter into another level of clear resistance and or bearish order blocks, okay, we have to anticipate what occurring, keeping true to form, because we don't like to try to find or pick rather the low or the bottom in bear markets. We would be more inclined to be sellers up here because we would be looking for this model to unfold. Okay, so as the market starts to break down at a known area of resistance in an existing downtrend, we could look for very easy optimal trade entries to sell short at. Okay, and now let's take a step back. If this is what it would look like on a hourly chart, okay, change it for a moment and say now we're on that daily chart and we had bounced for several days, that it's moved higher and higher and higher, okay, and it starts to move lower. We can now, in this area where we anticipate the market to start moving lower, you can utilize this area right in here on a daily chart. Okay, if this pattern's occurring on a daily or a 4 hour, when we enter this area in here, what do you think you could do with that in terms of day trading? Well, in here, it would be very easy to see the opening, a rally up or a Judas swing to make the high of the day, and position yourself for the move lower, ultimately aiming for the neutralization of the original consolidation and or eventually breaching this support level. Because again, our belief is that long-term macro trends continue more times than they reverse. Okay, so yes, eventually all trends are going to reverse, and there's going to be bounces along those trends, but ultimately, in a downtrend, what we like to see is resistance supported or affirmed. In other words, or respected. So in other words, resistance is confirmed by seeing rejection lower in price action, and we want to see support levels breached. That's what we that's what we want to see in downtrends. And the reverse is said, obviously, for bull markets. We want to see support levels confirmed or affirmed, okay, and see bounces higher in price, and we want to see resistance levels breached. Okay, when we see that, we see strength in those existing trends. Assume for a moment that we are wrong and we didn't see this as the actual low in the higher time frame trend. Okay, if we see this area here, see it rally up and blow out this high here, we know that we have most likely changed tides, at least on the higher time frame or the time frame that this fractal pattern is underway. Okay, doesn't always mean that, but we have a high degree of probability that that was the case. So in other words, if we don't get down here, okay, the opportunity now shifted to a bullish stance here. So then you would see a classic, what we identify as an ICT optimal trade entry long. From here is the price swing here. We have an impulse move, a retracement, and then this would be a 62 to 79 retracement level of the swing from this high to this low, and a classic buy here. And that would be a continuation. So the sell model changes gears to selling short in a downtrend to buying. Okay, you'll be a buyer using the sell model. See what I'm saying when I'm talking about how you can use them interchangeably? There's no hard and fast rules to looking at fractals except for the fact that they exist within one another, and they can segue from what would be deemed a bullish fractal right into a bearish fractal, and vice versa. So if that doesn't make any sense to you, we're going to actually look at some examples in a little bit, and it'll make a lot more sense to you. So now, using our previous example in volume 6, okay, we're looking at the Aussie yen, same area of price action. I used a very generic area. I didn't try to pick the best of the best. I just picked a very discernible, measurable area where we could clearly see support level at around that 91 figure and 90-80 level. Okay, and let's take a closer look at what you should have seen in price. Understanding fractals. As we see here, we can clearly see and identify the original consolidation. And this is the same thing we used, or same chart rather, we used for the buy model in volume 6. We had the consolidation here, it drops down, makes the high here, I'm sorry, the low, and reaccumulation. And this is the area where we move into the smart money reversal. Well, I'm sorry, this is the smart money reversal, and this is where we distribute what we accumulated over here on the buy model. Well, the same price action, okay, laid out in front of another trader, this is what they may see. And both are correct. Okay, so don't read into that saying, well, if he sees a buy model and I'm seeing a sell model, we're not learning the same way. Yes, you certainly are, but you're just thinking individually. That's the beauty of trading. All of us are doing something different. Some of us are doing things similarly, but none of us are getting the same results in either capacity, whether we're looking at the market bullishly or bearishly. Okay, all of us have to identify those unique opportunities that we are willing to take the risk upon. Okay, so I'm giving you the tools to work within and find the opportunities that you are willing to put your risk on. Okay, I'm giving you the framework, if you will. If you understand these things, you'll have a whole lifetime of opportunities laid before you every single day. It doesn't matter what asset class either. But the original concept that we discussed is the initial consolidation, the run towards resistance, smart money reversal, redistribution, I'm sorry, the low risk sell, and then we have a redistribution or reaccumulation. Okay, and we're going to assume for a moment that we're in a bullish area, or we are not in a bear market. And assuming that, um, there will be traders that would look at this pattern and they may see this and say, okay, it's going to come down and clear out this level here and anticipate something down here in a lower form of a price swing lower. But let's actually go over to the charts and look at this in a different context, but you're still using the fractal pattern, uh, the sell model. Okay, folks, we're looking at the Aussie yen. This is an hourly chart. This is basically the same sample set of price action we used in Market Maker 6 when we disclosed the buy model. Now we're going to talk about the sell model, but we're also going to pull in examples of using the buy model in conjunction with the sell model interchangeably. Okay, so you can kind of use both patterns to still find trades. I identified the 91 big figure and 90-80 levels as we talked about in volume 6. And I want you to take a look at price action here. And where do you see the ICT sell model? And I'll give you a hint. There's lots of them. We have original consolidation over here, right in here, consolidating on this 91 big figure. And we're going to identify that as soon as I can get my we have the original consolidation in here. Okay. We have the reaccumulation. We have the smart money reversal. We have the low risk sell. Redistribution. Ultimately coming down to clear the original consolidation that began the market maker sell model right here. So we're below the consolidation right there. So we have the accumulation, reaccumulation, or run to resistance, smart money reversal, low risk sell, redistribution, distribution. Okay, so there's your market maker sell model right here. If we look at this sample set of price action, okay, you'll notice that there is other market maker sell models. Okay, we have one here, the accumulation, the run to resistance, reaccumulation, smart money reversal, low risk sell or distribution, and very quick movement in here. If we probably went down to a lower time frame, we would probably get something in here, probably close to this area, and then moves down below the original point of reaccumulation. But notice it does not clear the original consolidation. But look what it's done. It creates a buying opportunity in the model of a sell profile. Okay, see all the context that we disclosed earlier is there, but the buy comes down at a known level of support. Let me get this line right back where it needs to be at the 91 big figure. I apologize for that, guys. So we have the buying opportunity here, and it worked within reaccumulating longs at this original consolidation. If you look at what we have done, we moved right into an ICT bearish candle, which is a bullish order block after price rallies away from it. So the down candle prior to the move, just like in the sniper series and precision trading concepts video series of mine, we discussed this is an opportunity to be a buyer. Okay, and we could use the overall context of the sell model that leads into the buying opportunity. Remember that stage, that's the second distribution, could become a reaccumulation or long opportunity. Okay, so that's the part that's going to get you mixed up if you don't have the higher time frame premise in mind, and that's why it's important that you have it, because if you don't, it'll cause you some pain and many times some frustration. Now, we had the opportunity to look at the market over here in volume 6, where we had the market maker buy model, where we had a consolidation, move down into a buying opportunity, moved up and took out the original consolidation over here. Okay, consolidation, redistribution, or run to support, smart money reversal, low risk buy, back into an area of the reversal point, and then the same thing happening that we would see here, a buy model, consolidation, breakdown to a support level, is happening here. Consolidation, breakdown to support, false attempt to go lower. This is the smart money reversal. This is your low risk buy. It comes back up, clears out the original consolidation, and then we talked about how this is the pattern here and not to be concerned about this here. The reason why I said not to be concerned about it, because we're talking about it in this volume now. What is this part of the market maker buy model that we said that wasn't important in volume 6? Because at that time it wasn't important, because I'd have to talk about what we're discussing in volume 7. So looking at what we have here, okay, we have a market maker sell profile here, right off of a support level, 91. We have a consolidation, okay, comes back down, retest, rallies up into an area of resistance. Well, wait a minute, what's this resistance over here? I mean, you have this big candle here, okay, but where's the resistance? It didn't come to this low, right? So where's the resistance? Why? What was all this business? Why did it have an issue getting higher than what it did here? Let's look at that. If we have the understanding that these patterns are going to form off of support resistance levels as we deem it in ICT camp, what caused that? What was the catalyst for this area having a struggle getting higher? That we could frame the idea that this would be an area of smart money reversal and low risk sell back down into either clearing the initial consolidation or defining it as a reaccumulation for a bullish scenario like we're going to discuss now. Well, we talked about earlier in this video series, the ICT Market Maker Collection, an idea of a breaker. Okay, if you go back over here, this candle right in here, the down candle prior to the move that's rallying up, that takes out highs. See this high here and this high here? Look what it's done. And I don't want to go over and reteach the whole concept of the breaker, but this is why it's useful to know what they are and what they're doing and how they blend with everything else in my repertoire. Okay, so we have a high here and a high here. What's resting above those? Stops. Okay, so if the market rallies up and blows them out and then comes back and ultimately comes and collapses, we go right back to the original down candle prior to the moves up. This is where they used the buy orders to run the stops. So they bought it here, rallied it, took out all the opportunities for those that were going to be short that would ride any move lower. Okay, when price comes back out to that area, they have to neutralize that. They have to take off those buy orders that necessarily weren't released here. because the market moved too quick. So there's a mitigation underway, okay, or what we understand in classical terms, trader remorse. Um, I don't believe that's the case all the time with smart money, but they use this function, okay, to take stops out. That's how it happens. This is what goes on an institutional level. So when we have price come back up into it, they only release the longs that they had to carry through all this. And when it comes back down to this area here, there is a change in gears. The market is not willing to go lower. Okay, so um, while there is times when certain parties of what we deem smart money is not right, they will have to work out of a position that may not be favorable for them. And because they don't trade with stops, because they have very, very deep pockets, they have to work with areas of liquidity and liquidity pools and stops and such. Prior to this move up into this area, okay, the next level of liquidity or liquidity pool was right below these lows. See these equal lows here? We talk about that as very clean levels, and that's not going to happen all the time where prices see that and it's never comes back to it. Many times it'll come right down to it and clear it. So stops below this was the objective from this point here to here, and then we had a reaction away from it. Okay, and we had a sticking point right there. What was the issue there? The bullish candle or bearish order block prior to this move lower. If you go right down to the low here, you can see it goes right to it here by a pip or two more. Okay, and then comes right back down. What's it dipping into? This overall down candle here that looks like a high, very long wicked. Uh, everybody likes to call it pin bars or a doji. Inside this candle, certainly there's because we're looking at an hourly chart. We're going to assume for a moment that this is an opportunity that we would see a lower time frame bullish order block, and I'm quite certain it's there because if you go back and look at what we showed in volume 6, I think you'll see it. But to keep things moving along, we have these two levels in here, just as we described, would be necessary for the formation of fractals. Okay, so now let's take these off and keep this in mind. That's the premise of what leads to these patterns formation. So we have a consolidation up to a reversal point down into an area of reaccumulation. Then it rallies off. Now notice that this sell model is in the context of the overall buy model. So we have a consolidation, it drops down to a reversal point, low risk buy, comes up ultimately clearing the initial consolidation with this high here, but then resumes and moves higher. Well, why was this taking place? What's the catalyst for that? Like what's going on there? Go back to this original consolidation over here. Okay, we have a consolidation, a move lower, a redistribution or move to support, which is here. Smart money reversal, low risk buy, comes right back down and does what? It creates another opportunity to go lower but doesn't do it. So we have a double attempt at going lower. So this becomes your false break. Okay, it doesn't go higher than the sorry, it doesn't go lower rather than the initial low here. Okay, so here's our secondary smart money reversal. Okay, and it's confirmed when you have a high here broken. So market structure resumes bullishly here, and then it really is bullish when you take out this high here, and it comes right back down and does what? It reclaims this order block. What? Yeah, it reclaims this order block to do what? To run stops again. Okay, we have stops now resting above this. Okay, there's liquidity resting above this high. Also, we have this move down over here that was rather sharp. Okay, and we want to utilize the bullish candle prior to the moves lower. Here's your bullish candle. Here's a bullish candle here. If we look at that, using either or, it gives you a nice area to anticipate. And between this level here and this level here, this high resides in the midst of them. Ultimately does blow higher, and let's note exactly what it reached into. It went above this swing high here. Even though we have the high here, we have a swing high here. So above the swing highs is where the liquidity is going to rest. And nonetheless, if it goes to this level here, just the spread alone would probably tag out then the orders that would be pending here. So we have these levels in this sample set of price action. Okay, but let's get back to the heart of the matter here in regards to the fractal patterns or cell models. We have a cell model here as well. We have a consolidation. Now I know you're probably saying, well, what about this? Why aren't you counting this? Okay, well, I'm not counting this because the price had already moved away and then moved into consolidation here. What's it consolidating on? The top of this bullish candle or bearish candle, which is a bullish order block. See what I'm saying now? There has to be a model, okay, of these profiles on the context of a support or resistance or order block. Okay, so we see a very sharp move away. The candle engulfs the down candle. It breaks through it. Okay, now we're consolidating. So what's the framework or basis for support here? The top of the bearish candle, which is classically defined as an ICT bullish order block. The consolidation's here. It rallies away. Okay. Reaccumulation. Up into smart money reversal. False break. Breaks down. Low risk sell. Breaks down. Redistribution. Boom. Clears the original consolidation right in here. Let me draw that out for you just in case. I know this is probably a strange one and one you might not readily see, but I'll just give you the major parameters so you can see it conceptually. And I know some of you are rather cynical right now, saying, well, obviously this is going to look perfect because it's all in hindsight and you can't do anything with it in the past, but look pretty and smart on the video now. But I'm telling you how you should mark your charts up after the fact to learn this. Okay, by looking at fractals and the way they transition from one to another, you'll build an idea that is going to very easily digest the price action when you look at it. You'll see the patterns there. You'll know exactly what it should be looking for in terms of where the liquidity is going to pull price next. Okay, this same thing again over here in another context. It's the same way. Cell models in here. Again, I'm just going to give you the major parameters right here. Now, it's not very clear here, but again, if we go down to a lower time frame, you'll see all of the definition and details that leads to these major price points that makes up the market maker cell profile. Okay. Same thing here. Okay. It comes right back down into a reaccumulation. We have the same thing happening there. It doesn't go lower, it moves into an area of reaccumulation. Consolidation, reversal. It should break below here, but doesn't. Why? Because it's coming off of a higher level time frame support level. So this is actually teaching and showing us that this market is under accumulation. Why? We have a low, it comes down, rallies again. Off of what? Using this level as an ideal area to hunt it, the 91 big figure, but the down candle, the body of the down candle, this is the order block. So it reacts, boom, okay, breaks the highs, comes back down. Does it go lower than this low here? No, it does not. Does it even get, below, well, no, I'm saying the same thing twice. It doesn't go below this low and never even comes back to try to retest this low. So we're making a higher low here. It rallies again, creates a sell model, boom, what's happening again? We have a reaction bullishly. And then once this high here is taken out, this is teaching us that the market is what? It's under accumulation. They're buying it up. They're buying it up. They're buying it up. It's unable to make lower lows. Now, yes, it's still taking out equal lows here where the stops are, but it's not breaking down because overall the price structure is indicating that this market is under heavy accumulation. Once price rallies up here, clear out these stops, these highs and these highs, and up in here, it comes all the way back down and dips into this order block right here. So again, we see an area where the down candle prior to the move up right here, the bullish order block, is dipped into. But now what are we looking at in terms of market profiles as it relates to buy and sell profiles, ICT, market maker buy and sell profiles? Well, we have the initial consolidation here, the run to resistance, reaccumulation, smart money reversal, and inside all this price action here, if we go down to a smaller time frame, you'll actually see the finer points in detail what these. Well, actually, let's just do it because it really makes no sense to talk about it vaguely. Okay, here's this original consolidation. Price rallies up, reaccumulation, runs into resistance. Now, what resistance is this? Right in here. It is bottom of this candle here, the bullish candle prior to move lower, is a bearish order block, and this low of this bullish candle here is a potential bearish order block. And if you want to go back into here, this bullish candle, use the body low of the candle here as the basis of the beginning of the move lower. You see it had really nice reactions as well. And if we go to this one here, you can see it doesn't reach there, but it does get into here. So an example of institutional pricing, let's throw this in here as a means of completion. If we're looking at this whole area up in here prior to the move where it breaks out of it, if we take our level, okay, and we identify initially the first and lowest right in here. This is the lowest of the bullish candles prior to the move lower. Okay, we don't use this one because the price was starting to rally up away from that. We don't like that idea. We like the idea of the bullish candle, then the move sharply moving lower. So we have this one here is the lowest, and this one here is the highest. So this is our initial range to work within. Now we don't just say we like this zone. That's not what we're doing here. What I'm suggesting to you is in terms of institutional pricing, let's change this level so we can actually discern the difference. Okay. Now we have this range, this high and this low range. What we would do is we would start dragging our level down. Okay, and what we're doing is we're looking for areas where price trades a lot to. Okay. And there's nothing really there, so like maybe 2-3 points. Right here is a good one. Okay, 92.19. Round that to the nearest round number or institutional level. It's 92.20. 92.20 is right there, and I think the actual high in this candle is the 19. Nope, it comes right at the 20. 92.20. So that's the institutional level right there. We would have as potential area to look for as price moved higher. Another area or price level would be ideal would be this one here, because we have the high of this candle's body, and we have the high of this candle and the opening of this price candle and this high of this candle here. So that's a good one. About 92.15 rounded to the nearest 5. And another level would be this one here, 92.11, and the reason why is because of the opening of this candle, the high of this candle, the opening of this candle, and the low of this candle, and the high of this candle. So there's a lot of activity around that price point. Okay, so a lot of touches to that level. and I would just round that down to 92.20. I'm sorry, 92.10 level. And it's also really, if you really look at what it is, it's half of that range right there, and it comes right at the 50 level. So that's a safe assumption to look at how institutional order, I'm not institutional order, but institutional pricing is done when you look for entry points or exit points for your particular trade. So I tossed that in there in case earlier in the video series you didn't get the concept of what institutional pricing is and how we glean it from price action. So nonetheless, I mean, that's how precise it can be. But we have price coming down into this bullish order block here, reaching up into this area of consolidation. Okay, and we just discerned how we can pull out the institutional levels inside this larger consolidation. So with that in mind, we know we have 92.10 to 92.20 as respectable levels to concern ourselves with. So let's put those in on this particular chart. Okay, so there's our two levels to look at. Smart money reversal breaks down. Doesn't really give us any opportunity to resell in here, and no, it doesn't really give you anything. The market moved way too quickly and just really ripped right back down into the original consolidation, back into an area the body of the candle, the down candle prior to move higher, right into that order block. Boom! Look how perfect that is. I'm still amazed by it, and I've been looking at it for years. The take out this box here. So we have a consolidation, sell, right down into a reaccumulation, which could have been a distribution, but it doesn't come to fruition. We have the swing high here. This is what you would see classically at a redistribution. Okay, 62% retracement level, moving right up into the bottom or low of the bullish candle prior to the down move. Right there, perfect precision concepts underway, and it sells off. But it only gives you about 30 pips. Now 30 pips is nothing to scoff at, but nonetheless, it only comes back down into a higher time frame concept that we're moving higher ultimately, because we've been making higher lows, higher lows, higher lows, and we came down and cleared out these equal lows we talked about earlier. Runs the stops there, rallies, takes off, and now we're reaccumulating in here, where we're in an area where redistribution should take place in a market maker sell profile. This is that point at which, if you don't have the higher time frame premise in mind, it will nail you and you'll be wrong and you'll take a loss. Okay, but if you're thinking objectively with the higher time frame premise in mind and looking at the overall price structure correctly, this is what can happen. You can be looking to be a buyer down here with the sell profile, or using the buy profile right in here. We have a consolidation, price moves lower, breaks to support, smart money reversal, low risk buy, reaccumulation, clears out the initial consolidation here. I know it's hard to see, but if you think about what we've shared so far, the pattern's there. Okay, and let's see what happens. Price continues to move higher, and where's the trade up to? The institutional levels that we just noted. Look at how many times it hit it, didn't quite get there. We had some pull away from it. Trades down, runs deep into it again here, moves right into it again, starts to break down a little bit again. What do you see here? Do you see another market maker sell profile? Consolidation, run to resistance, reaccumulation, smart money reversal, breaks down into what? This should be redistribution. But because we're in a bullish scenario, the area that would be redistribution, we look for reaccumulation. We want to be a buyer here, not a seller for a break below this consolidation here. We don't want to see this block of orders be taken then. So using the sell profile, we can look for this area to be an area of continued support. So in other words, it should not breach this area here. Now think about what this is telling you. If we do see sell profiles, okay, that are being supported as buying opportunities, eventually when that stops happening and these areas here that would be maintained as support, if these are broken, that's our early indication that the trend is changing. How about that? That's pretty neat, isn't it? So that way you can get an x-ray view of what market structure is going to do before it even happens. That's pretty neat. Okay, so we see in this area here as a buying opportunity, price moves up, rallies. Okay, we have another scenario here, consolidation, rallies up, smart money reversal, comes back down, where there should be redistribution and selling lower to take out this area here. It doesn't. Why? Because we're in a bullish scenario. Okay, we're in a bullish scenario, so this area should be maintained or protected. You ever hear of an area where they are calling it a defended levels? This is where that idea comes into concept. This is what it looks like. This is how they defend it. Okay, so when a bank or an entity comes in the marketplace and defends a particular level, okay, it may be option expiration, it may be other factors that are fundamentally driven that it's going to be outside the scope of this teaching. This is where we see the basis of what it looks like and why they'll be defending it. Okay, they're going to defend this area here. So in other words, the profile that would be a selling scenario in a bearish market, it's going to be an area of reaccumulation. And then you'll see the classic, what everyone fell in love with when I first came on the scene in 2010, teaching concepts in Forex that's been used in a lot of my trading since the 90s, the classic ICT buy scenario. Okay, and then everyone sees a move higher in price. That's going to do it for this particular volume. I think that if you spend some time with it, again, this is only just one sample set of price action in one particular pair even. If you look at price action on all the pairs on a weekly basis, even if it's pairs you don't trade, it's good study. It'll help you discern what price action should do going forward based on what it's done in the past. And that's a good, efficient use of your time instead of just looking at the charts, not knowing what it is you're looking for, okay, and then reacting to price action once it starts moving and then chasing it. You don't want to do that. Okay, you want to have an idea of what you're anticipating and then trading in line with that anticipation. So with that, guys, I wish you good luck.